All right. Thank you, everybody, for joining us today. This is being recorded, so one thing I say at the beginning of every one of my webinars is if you're not very familiar with this strategy and or options in general, watch this again so that some of the concepts really start to sink in. If you watch it down the road a couple months or so, it's going to be like relearning everything all over again. And this is going to be a strategy for a bull market assumption. Now, keep in mind, it doesn't necessarily have to be the overall equities. If you're bearish overall equities, there's always opportunities in the market. So it could be an ETF or a stock in particular that we're going to be looking at this strategy with. But I got to go over a couple of things real quick. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal. I've been trading my own money for well over 20 years now, and I'm here to teach you guys how to take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. If somebody else is taking control of your risk for you, they're going to be making the same mistakes that you are, and you might as well go out there and do it yourself. Learn to do all of these things yourself, because at the end of the day, that money that you're paying them to do the work for you is really eating into your overall yield and your return. And I've traded most markets throughout my career. From Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. I actually started out trading in college with a psychology degree and switched it over to finance before deciding I was going to go and work in the pits in Chicago. So I've been trading for quite some time. And I got to go over this disclaimer really quick. It says any opinions, news, research, analysis, or other information contained in here or material provided by pro traders, strategies, associate companies, or employees is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Excuse me. And the reason why is because, you guys, I don't know your risk parameters. I don't know what's in your portfolios. And so what I'm talking about could exceed your risk parameters. But if you're going out and, as a side note for this particular one, a lot of people look at options as being more risky than stocks. And with this particular strategy, I'm going to show you the correlation between the two. And this actually carries less risk than you would with just going out and buying a stock. So that's the beauty in options as far as I'm concerned. They really, in my eyes, are not any more risky than any other product out there. As a matter of fact, there's a lot of ways to reduce risk with options where you can't do that necessarily outside of this type of derivative. And at the end of the day, please remember the past performance of any trading system or methodology is not necessarily indicative of future results. So this is going to be creating a long stock position for the bull market assumption. And anytime you're long a stock, you don't want it to go down. And that's the same with this idea. But we're going to be using options to synthetically create a long stock position. So it's going to be great for oversold stocks that have really had a down move. You know, I like to look at something like a 10 or 15% pullback, especially on something like that has just had good earnings. And, you know, just because it gets pulled down with the rest of the overall market, it might create an opportunity to buy. And that's what we're kind of seeing right now, is this big pullback. This pullback today basically erased the last 42 days of just complacent, you know, slight upward movements in the market. We've kind of erased all of that. It's not really turned into a bearish trend yet, but there's still going to be a lot of opportunities, even in a market that starts to trend down. So we're going to be looking for those right now. We have to have a bullish market assumption with this. This is great when there's a bull market. We are in somewhat of a bull market, despite the fact that today was a big counter trend day. It's still in a bull market. And this is great for smaller accounts. Now, if you have a smaller account or you are a new trader, this is going to be a great strategy for that type of portfolio, because when we're using this option strategy, we're going to be able to basically have the same risk reward of the long stock position. It's not going to be exact, and I'll go into details as to why that isn't going to be exact. It's because when you buy 100 shares of a stock, let's say, there's a thing called delta, and delta means for every dollar move up, that's what the price moves up. So on a stock, if it moves up $1, you've gained $1. So that's 100 delta. If its underlying moves up by $1 and the delta is 98, it's really only going to move up 98 cents. So sometimes we are not going to be able to have exactly 100 deltas. And the more that this stock really rallies and those calls go deep in the money, the puts really lose their delta, and although the calls will gain in delta, it's not always going to be 100 delta. So it's very, very close, and that's why it's synthetic in a sense. But the risk reward of this is going to be very similar and almost mirror the long stock position. But we're going to be able to use about 75% less capital than you would if you had to go out there and just you went to a discount brokerage house or you went to your bank and bought the stock. You know, if you bought 100 shares of a $100 stock, you know, that's going to cost you $10,000, where this is going to cost you about $2,500. So it's about, you know, 75% less capital. If you did it on margin, sometimes like if you're on toss and stuff like that, you can buy the stocks on margin and you pay basically 50% of the margin to buy the stock. So a $100 stock, you're basically doing it for $5,000, and then, you know, this is still half of that yet. So it's still great in the sense that you're using a lot less capital to do that, and in smaller accounts, that's what makes it, you know, beneficial for the smaller trader or the smaller account, because you can really create a diverse portfolio doing this, and it will act the same way as just a portfolio of stocks. And by doing this, it's going to increase our return on capital, because remember, we're going to be able to gain $1 or gain $1 for every dollar the underlying moves up. But because we've used 75% less capital, that really makes our ROC go through the roof. All right, so building synthetic short stock position, we're going to be buying an at-the-money call and then selling an at-the-money put. Now, I always like to try and build this to where I'm trying to get a bit of a credit for this, and that will, in a lot of times, put our break even below where the underlying is trading. So that's even another benefit I didn't put in there. And when can you ever go out and buy a stock on a day where you're actually buying it below the market? You can't do that. Well, with this strategy, we're going to be able to do that. And if you didn't want to do 100 of the underlying, remember I was talking about deltas. We're trying to build it with 100 delta, or as close to 100 deltas as we can. That's what's going to happen when you do it at the money. If you wanted to do it for 50 shares and have it kind of act like 50 shares, then we could do a call with a 25 delta and a put with like a 25 delta, and that would synthetically create it to where it was 50 shares, because if it's 50 deltas, then it's going to move up 50 cents for every dollar the underlying moves. So it kind of creates a synthetic less than 100 shares. What is the difference between this and the strangle or the straddle? Well, with the straddle and a strangle, we're selling or buying both the call and the put. With this one, we're going to be buying the call and then selling the put. Okay, so a straddle or a strangle would be selling both or buying both. It is kind of similar to a risk reversal, yes. This The keys to success on this, picking the right underlying, I talk about this in every single one of my webinars, is when we're talking about the keys to success on this and the underlying, because options don't always have the participation that the underlying has, we need to make sure that there's a tight bid ask, because we want to be able to get in and get out of it for that. And yes, selling a naked put will have an impact on margin. Yes, it will. But the margin that they're going to be collecting is less than what, or they're going to be holding is, you know, a quarter of what you would do buying the outright. And if you bought this stock on margin, you know, usually you only have 50%. This is going to be 50% of what the margin would be if you were to buy the stock outright. So, but if you're worried about downside risk, then we can, I'll show you ways that you can define your risk to the downside. Trevor's asking if this is IRA friendly. I believe it is, and I think that IRAs are a little quirky in that when you're doing naked options, they're really only concerned about naked calls for some reason. So I don't think that the IRAs are as biased towards the puts for some reason. I guess because they assume the market always goes up. So picking tight bid ask is what we want for this one, and picking the right strikes. Now that this goes back to really how many deltas you want. So picking the right strikes, if you only wanted 50 of the stocks, you need to make sure that you're picking those strikes that are 25 deltas only. So picking the right strikes. And when I'm talking about this, when I'm selling the at the monies, I always like to try and collect a credit. So sometimes my calls are just slightly out of the money, and that allows me to get more for the puts. So the puts will pay for those calls, and that will a lot of times lower the break even below where the underlying is trading. So that's what our goal is. Sometimes you do have to end up paying a debit for it, which I don't really like to do, but if you can collect a credit, that's another situation where you could go out there and use some of that credit that is positive and buy that put to define your risk to the downside as well. All right, and the right duration. Now we want to do it far enough out, and a lot of times you can go out pretty far with these and still collect a credit, and sometimes in some cases the same credit is collected as if it were in the shorter duration. So I like to go as far out as I can. I mean, if it's 100 days, this is something that I kind of want to put in my core portfolio, then that, you know, you want to create the longer duration for that. And picking the right environment. The right environment in this regards, and I always use these keys to success, so I try and use these as checking off the list to make sure that I'm coming up with something. It's a little bit more difficult on picking the right environment with this strategy. Volatility expansion will help us, but at the onset, you know, volatility contraction isn't necessarily going to hurt us too much, because we're going to be collecting a credit on that. So if volatility contracts a little bit, our credit will come out of that a little bit. So that will actually help us too. Oh, sorry. I don't know why is this going? Oh, you know what I did? I copied these keys to success from a long call butterfly. I'm sorry. And, but I'm talking about the synthetic long stocks. So, and I'll just skip over the last one because I forgot to change those. Synthetic long stock is what we're talking about. But I just copied my keys to success because I go through the keys to success on every strategy and try and use that as my checkoff list. I'm sorry I made that mistake of not changing that. And knowing our exit strategy. So one thing we need to know is what our exit strategy is. And what I usually look at is if I initiate this strategy and I get a 10% down move in the underlying, that's probably when I'm going to look to exit this. And on the upside, if you're technical guy, I would default to those technical analysis type things as to where to get in and out too. So that is going to be more or less along the lines of what the more or less what the buyer of this is. It's kind of like, if you think about it, if you were in your shoes buying a stock, what would be your paying point on the way down to get out, and or where would you look to get out of this on the way up? And usually I'm looking for like a 10% move or something along those lines to get in and out of this strategy. And keep in mind, probabilities of success with this strategy is about 50-50, and that's really the probabilities of buying a stock out there at any given time. Larry's asking, so IV doesn't really matter. It doesn't really matter so much in this particular strategy. IV is not going to matter. Just kind of like when you're buying a stock, it really IV doesn't really matter for that stock either. So you can really get away with it. Expansion will kind of help you, and even a contraction could possibly help you. It just is all going to depend on the other variables when that happens. Usually with a upward biased move, volatility is going to contract on you. So you don't generally get IV expansion in a bull market, unless it's gold, of course. All right, so our max profit is infinite. As with buying a stock, our max profit is infinite, and just like with a stock, our max loss is if that underlying goes to zero. The break even on this is going to be that long call that we have minus the credit, or if you get a credit, your break even is going to be that call minus the credit you receive. So that's where it lowers it. Or you have to add the debit, and then that is where your break even is, which is why I like to do it for a credit. All right. So let me pull up this is usually a part of the webinar where I kind of throw it out to you guys to give me some stocks that we'll look at. I've got a couple I've already vetted that I think will work out pretty good, but I like to see what you guys really like. And it makes it go a little bit better, I think, in that regard. So, you know, these are going to be stocks that you think are going to go up. Bobby throwing out Amazon. Yeah, Amazon never seems to go down, does it? At least until they completely take over the world. So for you guys, you know, I'm bearish the market. So, you know, and I've been talking about this target on Twitter for quite a while. An SPY, it's the 211. That's going to be a support level. And this is a big sloppy head and shoulders pattern. So this is the breakout, the upside, the bull breakout. So as long as we can stay above this line, for the most part, that bullish assumption is still intact for if you're looking for a bull market assumption here, and that would give us opportunity to buy here. Anything below this, and especially this line right here, this is your trend line. We break below that, and then, you know, it's going to really, this is the magnet, this is the point of control, this is where the most time has been spent for this market. But if it gets below this much, it's going to want to really start coming off quite a bit. All right, so got a bunch of people throwing some stuff out, so let's look at Amazon off the bat. Excuse me. So Amazon, this was the old trend, or the old Fibonacci level. It's a little bit higher now, but that's still going to actually act as a support. That's a really old chart. So, but this is going to act as support right here for Amazon. So this might definitely be a good time to look at Amazon for sure. As you can see, it doesn't have a tendency to go down for very long, and this could be considered the pullback that looks good. This also is probably going to be something that could get a little expensive. And since we're going to be doing mostly at the monies, I'm going to shrink that down a little bit. And so like I said, we could look at the 42 days here, but that doesn't give us a whole lot of time to be right. And it's trading at 60, so the closest one is 60 on here. That's going to be a debit then. So we're going to buy this call, which makes it pretty easy. And this is what I was talking about. You look at this. This is the delta of 52. And then when we sell the other strike here, we're going to be looking at 100 deltas. Sorry, that's actually over. I thought that just said 48. Oh, because I picked the wrong strike. Sorry. So we're doing the 60 and the 60. So if we add up the deltas, so this is the one I actually did, 48 deltas and then 52 deltas, you add those two together because I'm getting long these deltas, and then because I'm getting short these deltas, it's a negative, and a negative makes it a positive, all right? So that's, that is when, how you add it up to make it, 52 minus a negative delta is adding it together to get you 100 deltas. So this would act just like it. And we're getting a debit, so our break even is actually above where this is trading right now. And Trevor's asking, when do you use at the money or out of the money strikes? Usually if you could buy the, like this particular, if we can buy this or sell this call and then buy this one, sorry, buy this call and sell this put, then that's going to give us a $3 credit. So the time that I'm going to pick this call that is out of the money, and it would look like, you would think that you have a lot more to it, higher to go to get it. But as you can see here, when we did the 60 call, we were doing it for a debit. You're going to play around with it. Wherever your break even is the lowest is how I determine this. So, look at them both. Buy this one. We want to sell that one. Our credit is $2.15, or debit is $2.15, which puts our break even at 62.30, right? Because we add that 62.15. So we got $2 to go higher there. And then, so if I look at this one, buying the call there, selling the put there, subtract that, that puts us at 60, what is it, 62.90? No, 61.90. So this is probably the one I would do, because that puts my break even lower, right? Because if we subtract the $3 from this, that puts us at 761.90. So my break even is lower than the other one on this one. So this is probably the one that I would do. Does that make sense for everybody? And I especially want to try and get my break even below, and I'll show you examples. Yeah, and then we can look at it on the Analyze tab for sure. So let's look at it on an Analyze tab, and I actually want to do something for you on this. So let's look at Analyze this trade. And as you can see, this is a complete diagonal, which means, it's basically a 50-50 shot all the way down. This, I could shrink this and it will go forever in either direction. So let's get rid of that and look at doing the trade if we went and just bought the stock, and do the Analyze tab, analyze the trade. It's the same parameter. Okay. And Nick, great question. Can you buy the put to define the risk? Now, what I'd like to do, yes, you could, but keep in mind, paying $17 for the put to define that risk to the downside with something like as big as Amazon is going to hurt. So on that one, you kind of have to be big dog on this one. So let's look at Goldman Sachs. Nick likes Goldman Sachs. I'm not a big fan of banks, although Rosengren said that Fed's still going to raise rates. So this would be a situation, it's trading 68.50. So we're going to look to buy this call, and these are getting really wide out here. Usually it's a lot tighter. 10 cents wide is usually what I look for. And I usually look for it being tighter than 10 cents wide on any stock between 0 and 100 for the most part. And then you get up into the hundreds, 200s, of course you're going to get a little bit wider. There's usually a lot of volume and open interest in especially Goldman. So I would think that you'd probably be able to get a little bit tighter market. You can see that this was all the trade today, so that, and we're right at the money, so you would think that you'd be able to get a little bit tighter market. Anyway, so in this regard, I'd want to buy these calls, sell these, because I like to try and collect a credit for it, and that puts us at 68.57, which puts us right there at where we're trading. So the underlying is, our break even is right where we're trading right now. So that would be good. Again, if you wanted to define your risk, the way I define it is usually looking to try and finance the puts with this money here, because I don't want to, the more you pay for it, you're really pushing your break even a lot higher. Because if I did this, then all of a sudden my break even, if I added in buying this put, let's say, now our break even, we did a debit, so our break even is at 75 almost. We can even look at this. You can see 174.68 is our break even. Now, one thing to keep in mind, let me get rid of that. Probably going to have to, let me build this out again because I want to show you guys the buying power effect also. So $1.40 credit, so we can look at this. So our break even is, now it's changed a little bit, so it's slightly, we could say it's right where we're at anyway. But the buying power, so the buying power effect for this, and let me one more time get this down to a one lot, because just to make math easier for everybody, if you were doing 100 shares of this, it would cost you in a discount brokerage house or something like that, you're going to have the cash for it. So it's going to cost you $16,857 without commissions. If you do it on margin, so 62,957. I don't know why they're not doing for the options. Is if you did it with margin, it would be half of what it would normally cost, and this is going to cost us $4,000. So that is a lot less than you can get anywhere else. And again, we can check our deltas on this and look and see what they are. See if we're getting that 49 deltas here minus a negative 51 gives us 100 deltas. So for every time Goldman Sachs goes up by $1 or down by $1, our premiums are going to go up. This one by 50 cents if it goes up by $1. If the underlying goes up by $1, this is going to go up by 49 cents, and this one is going to go up by 51 cents. Okay, so that's what creates that 100 deltas, doing that to get it to act just like it. But when I was talking about if we go to all of them, so as you can see, the deltas, as we get really deep in the money, these deltas of the puts are going to stop acting or helping us, and these puts are going to continue to go up. It's aftermarket, and it's getting a little wanky because of wide bid ask, but it's going to continue to go up, and these would probably be closer to 93, 94, something like that. So the further it goes deep in the money, it's not going to be exact. We're going to be losing a couple of pennies here or there, but at the end of the day, it is very, very close. How does the credit affect your bottom line? Is the credit your max profit? No, your credit is not your max profit on this. It's going to continue to, because I see what you're saying, because usually if you're getting a credit, that is usually your max profit. With this, as we can see on this, our max profit is infinite. That's because as this goes up, you know, those puts that we sold are basically going to become worthless, right? And that's where our credit is. So we're going to get to keep that credit. But as those calls go deeper in the money, those are the ones we're long, right? So those continue to gain in value. Now, and the reason why on the flip side, the risk parameter is exactly the same on the downside is because those calls that we bought become worthless, but those puts that we sold, you know, start gaining in value, which hurts us. Does that make sense? And those deltas, the deeper in the money those puts get, start growing. Okay? So that's what makes the risk parameter around the same. So for instance, with this Goldman Sachs, you know, if we wanted to, if we were really bullish this and worried about the downside in this type of market situation, you know, I would probably look at selling the 150 puts. But like I said, I'm probably going to be looking to get out of this strategy if, oops, I hit sell. I wanted to hit buy on that. So you can define the put by buying it, and we still get a little bit of a credit, but it does increase our break even to 169, 169.64. So it increased our break even by that dollar. And on it, if it's down at 150, I'm probably already looking to get out of that just a few ticks before anyway. So to me, it doesn't really make a whole lot of sense to define the risk on this. I suppose if you are not someone that watches it on a daily basis, then you could define the risk. So, you know, that is your synthetic stop, if you will, for this strategy. If you like to put stops in, this would be your synthetic stop on it. And yes, John, great point. It does also reduce your margin, generally speaking. Sometimes you can be further out than what the margin is before you could buy it, like, or before you could define it. Like the margin is usually set to like 125. Usually it is a 2 standard deviation move for the most part, but we can look at this and I want to hit confirm. So we can see max profit. I don't know why it's saying the max profit is not applicable now, but and it didn't really reduce our downside, but something could be going wanky with that. I'm not sure why but a lot of times it will, unless of course, you know, because they usually try and get you for the margin to a 2 standard deviation move. Do you get to keep the credit and the gain? Is that right? Well, the credit really is, the credit and the debit is really kind of a moot point because, you know, if it stayed right here, then yes, you would, because that would create the theta decay and it never moved. You would be able to get some of it, but there's always going to be a little bit of extrinsic value, you know, in this because you're right at the money. But you would be able to, if you got this below where it was currently, it's really just going to act as a stock. I wouldn't look at it like you're going to try and get to keep that that credit. If you've done a webinar on iron butterflies, I would really like to get that recording. All right, yeah, Bobby, you can get that for sure. As a matter of fact, I just took off, and for those of you who watch my daily market commentaries and that are my regulars, I actually just took off the iron butterfly I had on in Verizon. I took that off today, so it's getting really close to the end of the thing. So think we did that for $2.52, and I took it off for $1.52. So yeah, Bobby, you can get that recording, or you can reach out to us at trading@ProTrader Strategies to keep it top of mind. So and I did that after the market commentary today, so I didn't talk about it. Got the big move down today, and I put it right very close to where our short strikes were at the 50s. Anyway, got a little regress there. But yeah, don't look at it like you're going to pay the debit or the credit in this scenario, because it is not going to work out that way, really. I would say 99% of the time anyway. Okay, so another one, now that we're on Verizon, did I cover everybody's, because it's kind of scrolled off with everybody's questions. If you want me to look at your stocks, throw them up there again. So let's look at Verizon. So this was one that I kind of already vetted. So it's trading 51.82, and then so we could do the ones that are the 52.5s, and I know I'm looking at the shorter duration than what I would normally, but this is for an example as to what it all works out to. So we get $1.10 credit for this. That puts our break even at 51.40, right? So that's 40 cents below where it's trading, even on a big down move day like today. And again, if you wanted to find your risk, this works a little bit better with the smaller stocks. So what do I got? 30 cents to get it to where we are right now. So I could go to, let's say, the 47s and buy that, because it's only going to be a quarter, and that puts our break even pretty close to where we are. So it's kind of like you're buying the stock now. You've got your stop in there. It's a synthetic stop, so if it gaps down, that protects you to the downside. You're not going to have to worry about it. This way you could just leave it on, right? You just left it on and allow the market to work out. If it goes down, you just kind of leave it on and let it expire, and if it rallies, you can make some money. So that's a good one. Where do I get the 30 cents? I rounded it. Sorry, Trevor, I just said around. Where do I get the 30 cents? I figured on, if I can take this off, where's the put? I did the math in my head. What I did is I looked at it like, let me just rebuild this. So if I'm going to buy this call, sell this put, what I looked at was I take $1.10 out of this, right? So if I take $1.10 out of this, that puts my break even at $51.40. So I kind of rounded it. So 51.40, it's actually 40 cents to get there. So I was just trying to figure out where I get to my break even, and I rounded and just went 30 cents. So to be exact would be 40 cents. So you could, in that regard, you could probably then go out and buy this one, and that should put our break even right there, close to where it's going. Still a couple 10 cents below, but does that make sense? Trevor? I was just kind of rounding. I was ballparking in my head real quick with the math. So you could do it that way. And that still has your break even below, so you've defined your risk to the downside, and that defined risk to the downside is just slightly better than a 10% correction on it. So you would be better, and if you're worried about downside gaps or something like that, then you have your synthetic stop in there. Okay, so could I check Gilead? So let's clear this one out, and then Gilead. Oh, so wait, before I do that, Nick, let me check something out real quick. I want to look at Verizon one more time, because I did the short-term one, so I want to look at what the long-term would be on this, because it ends up being pretty close to the same, despite the fact that we're looking at higher numbers. This is still the 42.5s, so we could buy the 42.5s here and then sell these or sorry, 52.5s, and sell those puts, and you still get that $1.50. So this one's just slightly better than the other one, and we've gotten, you know, twice 100 extra days almost, and 90 extra days by doing this. And you know, it's going to give you a lot more time to work it out. And again, since we got the $1.50, it lowered our break even to $51. We have 82 cents to play with. If our break even's at 82 cents, so you know, you could go in and buy the 46s. Okay. Why is it important to get the break even below the stock price? Because then you're getting something for nothing, right? I like to do it because, you know, that gives you a little wiggle room to the downside before you get hurt. Larry asking, where do I usually get out? I usually look for a 10% for me, up or down. I also look at the chart. So for something like Verizon, you know, I would probably look somewhere up in here because I think that this is going to act as a resistance. So that would probably be where I would look to get out, maybe on something like that. But if it like totally blasted off and went right through that, then I'd probably start looking to get out at the 10%-ish. So it would be like 56-ish or something. Trevor's asking, why am I the Wolfman? That is something Joe Kernan just started calling me the Wolfman when I was on the floor, and just would hit Rick on the shoulder, or he would tell Rick to hit me on the shoulder, and he was like, hey, ask Wolfman what the probabilities of the Fed raising rates is. And you know, of course, Joe Kernan would always try to do it when I was like really busy, and try and get me to do the math in my head real quick on what the probabilities of a Fed hike in a certain month right off the bat. I'd have to look at the price, do the math in my head, and like spit it out to him. So I think he got a kick out of it, but that's where that nickname came from, and it kind of just stuck. Larry, did I answer your question? I usually look for a 10% correction or 10% move, but it's for everybody's. It's kind of your own risk parameters. I would look at it like, if you bought a stock, where do you look to get out? I don't hold things very long, so some people might want to hold this a lot longer. With this strategy, what exit guidelines do you use considering potential profit and loss at that time? I think I answered that right, Neil. All right, so Bobby, how do you follow me on Twitter? I am at Wolfman's blog on Twitter. So Nick was back to Gilead. All right, so Gilead, you know, this is a good one because I like it when they're really sold off. So Gilead's a $70 stock. It's got 30-cent wide markets, though, way out there. Usually, I think Gilead has pretty decent markets a lot of times. As you can see, there's 4 or 5 cents. Go just check the volume and open interest. It's got pretty decent volume and open interest, which means that it's probably a lot tighter than that. So if I were going to buy this, I would probably not necessarily abide by the mid-market kind of thing. And that's another thing, you guys. Don't ever just do the mid-market thing. So 78. So we're definitely going to be below the break-even on this. And we're going to sell that put. So $2.50 puts us at $7.50. So yeah, we're below the break even there. I like it because, you know, if you went out and bought this stock, you know, I'm paying $78.12, and if I'm doing it this way, you know, 100 days, I would almost never hold the stock that long anyway. You know, I'm getting this at $77.50, so you can't buy a stock for below market price a lot of times. Only time you can buy a stock is when you bought the offer, and that's even if you bid it below the market, right? As soon as you get hit, it's offered there. And this allows you to get underneath that, which is why I like this also. So that one looks like it's pretty good, but you can see the natural is quite quite a bit far away. So, you know, I would look to probably go in trying to get a little bit more credit. And then if you guys don't have like cancel replaces like 3 or 4 times before you get filled, you guys are giving up too much edge. So put it in higher than you think you're going to get filled by, you know, a few pennies, like, you know, 10% or something like that. So like, you know, 2 or maybe a little less than 10%, but like a nickel is usually what I kind of look at. I try and go about a nickel above the mid-market and then put it in, cancel replace, move it down a penny, cancel replace, move it down a penny. You don't have to let it sit there for 5 minutes to get filled. You know, it's like 5-10 seconds because the computer is going to either get you filled or you're not going to get filled. And just cancel replace, cancel replace. Trevor's asking, when's the best time or the right time to put on this strategy? It's really, you know, if you really like the stock and you decided you wanted to buy the stock, that's the right time, okay, when you're feeling it. For me, what I look for a lot of times is, you know, a big correction, maybe 10% pullback on something, and then that's when I'm going to look to buy it with that. Or, you know, with Gilead Science, I mean, it's been beaten up. It's, you know, I like to use this market profile, and I've done webinars on that too. So I don't have time to go into trading market profile a lot, but the quick and dirty thing is this is going to act as support because that's when it gets overextended. Same thing as this is going to act as resistance because it's gotten overextended to the upside. And once it gets bounced off, like it's bounced off of that, it looks like it's doing pretty good. It's going to want to go to the point of control, which is, we used to call it the magnet, which is where the most time and volume is spent. So it's going to want to go back there because that's where the market has found value. Okay, so that's the idea of the market profile. So Gilead would be, you know, would fit all of those, you know, for me, the real good idea of having it. One thing to note on this, yeah, so they beat earnings and then they got slammed. One thing to note on this, the dividends will hurt you, and you basically end up paying the dividend because the calls are going to subtract, the premium in the calls are going to subtract out the dividend. So that will hurt you on this. So just be aware of that whole dividend situation. Try to avoid those if at all possible, especially on the onset of entering this trade. Like if the dividends are ways down the road, then that's not such a big deal. But if it's like, you know, you got the ex-dividend coming up, you know, 8 days out or something like that, that's probably not going to be enough time for you to really get that max move that you want. Does that make sense? So with Gilead, something like this, I would probably be looking to put this on and not and I would exceed that 10% level by thinking it's going to go back to this. So that would be much better than a $7 move. We're looking at a $10 move there. Does that make sense for everybody? So I was really looking at, you know, and if you're more bearish, the overall equities, like if you think the equities are actually going to go down and you still want to add something, you know, look at something like this where yes, it is overextended to the upside on this, but it's kind of really come out. Hopefully it's not creating some kind of crazy head and shoulders there for this, but, you know, look for the staples where Johnson & Johnson is going to do well in a bad economic environment. You know, groceries will, like, you know, Whole Foods. Whole Foods may not be the perfect example because people might stop worrying about organic and just worrying about getting food, but something like Johnson & Johnson, General Mills, you know, those staples, Procter & Gamble, that you could look at also. So, you know, and it's had a big move down, but, you know, it has, you know, that's why I like to get it when it has that pullback, is because that's a good time to get in. And we've had a pretty good pullback here. So people will, you know, there's a a notion of flight to quality, right? So when people are pulling out of like the Teslas that have these crazy PEs, right, then they're going to start throwing it into the staples and stuff like that. And those are going, because you have to put your money somewhere, right? And if you're bullish stocks, or sorry, gold, then you could do this with GLD as well. Or you could do it with GLD. If you think that gold's going to go up. Another way to do it, if you wanted to do it with something a little cheaper, excuse me, GDX is another one that is a little bit cheaper, and you could even do this is the GDX is the gold miners, and then the junior gold miners is GDXJ. So they are more expensive right now, but GDX is, if you wanted to get that same participation and not worry about the high flyers like GLD and you're worried about the downside, this would be a way to limit some of that in a sense. Do I do SAN, S-A-N, for 10% pullbacks? I usually like to have a 10% pullback at least, generally speaking. Some kind of big pullback is usually where I do this, because I'm the contrarian. I don't want to buy the tops. I want to buy the pullbacks when, especially when there's, we used to say when there's blood in the water, that's the time to go fishing, right? Oh, do I scan for 10% pullbacks? I don't really scan for 10% pullbacks. I probably could. I usually have my list over here of the stocks I normally trade and just start flipping through them. Does that make sense for everybody? So 10% pullback, or the thing I really like to look for is something like that Gilead Science, where it's gone down, broken below these value areas, or the support and resistance value area low, and then come back into the value area, then I think it's going to go to the pullback. Okay, so hey guys, for some of my regulars and the new people, we got a new, we're doing this particular offer for you guys. This is great. These are floor trader hacks. These are the things that we used to use on the floor. If you're going through and you're like trying to punch in the days to expiration for like the expected move, and taking the square root of that and trying to multiply all that stuff out on a little piece of paper. These are all different hacks for those kind of situations where you can actually save yourself a lot of time. I go into talking about what delta can tell you, and what theta components are, probabilities of being in the money, all of those fun little things. So these are the shortcuts we used to use on the floor. And keep in mind, when you're on the floor, you had to really come up with your quotes quickly, and you had to know what your risk was, your probabilities of being right, your probabilities of this going against you. And I go through all of that stuff. So these are basically 20 years of me learning hacks from some of the best traders out there, and I've created a whole little course on that. There's like 9 different, these are all the different courses of it: extrinsic dividends, figuring all of that stuff out, delta deviation or standard deviations, probabilities of being in the money, expected moves, all of those things where you can do it really quick in your head, and it's not going to be probably as detailed as if you punched it into the computer, let's say, for like the expected move. But at the end of the day, all of that stuff with implied volatility and everything else is really a ballpark anyway. So this is just as good of a ballpark as that is. It may be 5 cents difference or something along those lines, but at the end of the day, it's going to get you there to the answer in about 5 minutes faster. So that you know, when you're trying to find the right strategy and you're trying to find the right trade to put on, this will save you a lot of time throughout your day, and especially life, by going through that, and it'll give you the opportunity to move on to better trades. So check this out. It's a really good one. Spent a lot of time on that one, so that's good, and it will streamline your process for sure. What was the question? Debit spreads better for day trading than credit spreads? I don't like debit spreads, TJ, and I don't really trade options for the day trade, but it would all depend on volatility for me, where the volatility was. So like credit spread for earnings and stuff like that is where I would go. I don't ever do debit spreads for like earnings and things like that. But I've done a webinar on, you know, my favorite earnings trades and the way to set those up too. So you can check that out at protraderstrategies.com. So this link is actually in the chat box there. You can check it out. This is, I can't tell you enough, like this will make your life a whole lot easier. And there, I got little ideas where you can just put the sticky note right there, and it will help you out tremendously. So call us at Pro Trader Strategies. You can also, somebody was asking how to follow me on Twitter. This is it. It's at Wolfman's blog, and you can follow us at Pro Trader Strat. That's for the Pro Trader Strategies website. So we punch out all of our deals and stuff like that that are going on, and some other useful information on what the markets are doing. The other thing is this is the wrong offer on there, but keep in mind in later webinars we're going to be drilling down on different options and different kinds of components. And hey, reach out to us at Pro Trader Strategies and tell us that, you know, some of the strategies you may want to see if I haven't covered it or not. The other thing is, one thing I forgot to tell you guys, with this you also get unlimited access to me. You can reach out to me via email, and if you have any questions or concerns with your position, I can tell you what my rules are and help you walk yourself through that, and you know, how to manage something that may have gone against you. So I can talk to you through all of that stuff. Also, you get the daily market commentaries where I go through everything and I talk about all the trades that I've done on a daily basis, and when I get in, when I get out, how I'm managing that. Just like with the Apple trade, I just had an Apple earnings trade that went against me, and now I've rolled those out in time, collected more credit, increased my break even on that. So, you know, all of those things. Same thing with Target. You know, that was an earnings trade gone bad, and I am managing that by selling calls against it. So I talk about all of that stuff in those daily market commentaries. So keep your eyes out for those. And I also talk about economic, geopolitical stuff in there as well, what the data is telling me, and what I think of the Fed. So you get all of that, and those daily market commentaries are like little tiny mini webinars, if you will, of me talking about the trades and how I'm working through it, why I put them on, why I'm taking them off. So nice refresher for the webinars for sure. All right, so call us at 310-598-6677, or you can email us at trading@protraderstrategies.com. And on the site, yeah, you can look for the one on iron condors for sure. That's on there as well. And once you get onto the site, you know, you can go to Pro Trader Strategies and start playing around with it. Use the link that's in the chat box for the offer, and once you get signed up, basically it looks like this, where you've signed in and you can check off the status of it. You know, I've completed this, you know which ones you watched, and know when you've completed the course, and go back and refresh them and stuff like that. So you can reach out to us, Dominic, at 310-598-6677. They can help you out with the iron condor ones too. Yeah, you have to sign up to get the daily market commentary. Every once in a while, we'll throw it out there, like we threw the daily market commentary out on Twitter yesterday. So you can get some of those commentaries if you're following me on Twitter to watch those. Because they're really like, the bonus for signing up for this. It's a little 10-minute video every single day on, trading and everything. All right. That's all I got for you guys today. I hope you all have a great weekend. And if you can't take that, take it easy. Take care, everybody. Have a great weekend. Thanks, Ron. Hey, thanks, Rick. Good to see you back. You were quiet today, though. What happened? Have a great weekend, guys.